Yeah. Okay.
Only the slide actually, sir. I need to double check first lah before I
Okay.
submit.
No problem.
But
29
before
you still got
before
time.
29, yeah.
Yeah, before you still got time.
Yeah.
Okay. Okay, I tell you what, recording has started. Sorry?
Sorry?
You want to say something?
Yeah, because I just joined this group lah. But
Okay.
I read already all the
See.
notes lah.
Okay.
So far so good. Can understand lah.
Okay. Okay, I think we started recording now. It's 2 o'clock. I think we better start our class now. I don't know whether the other student can come in or not, or were busy or whatever it is. So anyway, okay, welcome to the class today. Today we have to do very fast 5 chapters. Okay, now before I start, I want to say it's very important you submit all your coursework. Your final exam will be determined later. Okay, and whether your
final exam, sir.
Yeah, we have not fixed the date yet. Because normally you will do 3 or 4 subjects and then we do one final exam at one time for 3 or 4 subjects. We don't do final exam for every subject. Your coordinator, I think in this case, will be Dr. Salmon. He will inform to you later on when is your final exam. Now, whether it's face-to-face, it means you come to the college, or you do off-site, okay, it will also be decided by your coordinator later on. Okay? Okay, so we are now coming to chapter 6 to 10. It's going to be technical. Okay, so it's going to be technical. So we don't have much time. So let me start. So can you all see this topic 6?
Yes.
Can.
Yes, sir.
Okay. Now your course, yeah.
Before that, can we know more about the journal things for the final submission for February? What is there any guideline, any format, or any number of words
for February?
Yeah,
yes, sir.
journal.
The article. I think we
Yeah.
need explanation. We haven't
okay.
explain it
Okay.
yet.
This one you should ask the coordinator, because you are submitting the article not only for this subject, you'll be submitting article for all the subjects. Okay, so it's a general discussion. Now, normally article you can submit for publication. Normally we will use Scopus. Scopus got 1, 2, 3, and 4 level. Scopus level 1 is the highest, and Scopus level 4 is, can I say, the 3 and 4 is the average. Now, I'm not too sure whether you need to submit to Scopus or maybe you need to submit to one of our own Lincoln journals. Okay. Nevertheless, the article follows something like the thesis. You may have chapter 1 to 6, introduction, chapter 1, chapter 2, literature review, chapter 3, methodology, research methodology. Yeah, chapter 4 is finding, then the conclusion, then you got recommendation. Now, most of you have got of course, I think most of you would have got a bachelor degree. You may have experience in writing your thesis during your BBA. So the article is something like that. Okay.
I see.
So one to chapters. In terms of words, of course, for the bachelor is I think 20,000 words. For master, I think is 40, and PhD is 60. Right? But you're not doing PhD and you're not writing a thesis. So you're writing an article, I think maybe about few thousand, 6 to 8,000, something like that should be enough really. But I'm not too sure. You have to wait for your coordinator to tell you. Okay?
Is it a real study, sir, or can we do it based on secondary data only?
Okay. Now, your research can be either based on the qualitative or quantitative. Okay. Now, if you are based on qualitative, most likely will be a forum discussion, interviews, forums, right? So that one most likely will be considered as a primary data because you're collecting yourself, right? Now, if you're doing quantitative, you may have to send out a questionnaire. If you're doing a questionnaire, I guess will be primary. data. Now, if you are not doing by this way, chapter 1 to 6, maybe you want to write an article that's something that is interesting to you and may not come back to chapter 1 to 6, you can also allow. And if that's the case, you will use secondary data. But every time you use secondary data, please quote the sources, and you must be careful because when you're doing secondary data, the original researcher is answering their hypothesis. Okay, they are answering their question. So may not be 100% suitable for your question or your hypothesis. Okay. Okay. So I don't think, I think most of you will know how to write a thesis. So it's just a shorter version. But the key point is your title. Okay. Your title should not be too wide. It should be a bit more regal. That means a more, how do I say, scope. Let's say, for example, if you write an article on Bangladesh banking, I think it's not really suitable because you guys are all in Malaysia, right? And then you should, of course, write something about your discourse. I think your discourse is an MBA. So you're not going to write something about nuclear science or rocket technology, isn't it? Right? So you got I think 10 subject, maybe HR or whatever, ethics or accounting, right? So you have to select one of these topic, and then well, it depends. I think they will ask you to submit your title to the coordinator, and the coordinator will vet through and see whether your title is it not too wide. Not necessarily must be really original unless you're doing a PhD, right? Maybe there's some gap somewhere you identify, and then you want to write on that particular gap, or you want to right, if there's any research gap and you want to write that's fine. Or if it's not a research gap, something new, it's also fine. But of course, you're not doing any PhD or Viva or something like that to defend. Not really. But at the end of the day, when your article is finished and you send it to your coordinator, they may be a peer-to-peer review as per normal, and plagiarism. Okay, master 30%. Okay, we are using 30. We are using Turnitin. We are using Turnitin.
Turnitin.
Turnitin. We are using Turnitin. Master not more than 30% overall. Not necessarily by chapter, because maybe chapter 2 a lot of literature review. You may do a lot of quotation, right? Therefore, overall, I think it should not be that problem. But of course, it's not a full research. If you want to do any SPSS or AMOS, it's allowed, but I think make it simple. If you're doing some analysis on the quantitative data, so you may need to come up some sort of questionnaire, right? And based on the research question and also based on the hypothesis, and then maybe 4 or 5 research questions. Therefore, 4 or 5 hypotheses. Forget about now. You don't need to waste time on that. The hypothesis, you no need to wait. Okay, just do 5 research questions, 5 hypotheses. If you want, you can put in the what you call that one, framework. Okay, conceptual framework. You can draw a small little diagram using Excel or something like that. Some software, right? Do some diagrams. Anything else? Yes. References, we are using APA. American APA. Take the latest one. I think it's 7th edition. Okay. The APA reference methodology. Okay. Anything else? Article. Anything else you want me to tell us about article? Oh, you can use
submit by
you can use simple correlation will be enough lah. Either you use a correlation or regression. No need to do factor analysis lah. It's a bit tedious because you have to find all the hidden variable. Okay, elimination hidden variable. Sample size. If you are doing sample size, so let me see first. Confidence level 95. Worst case is 90 lah. Not less than 90 confidence level. Normally 95 lah. Margin error plus minus 5%. Standard deviation 0.05. That will give you maybe about 385 sample respondent. Now you can send out your questionnaire, or if you're doing quantitative, I'm talking about quantitative. So qualitative, no need to forget about this sample size thing. So if you're doing quantitative, so it will be questionnaire. You can send out by Google, right? But maybe you can send out a lot and maybe the people don't answer you. It's fine. I think in theory, 95 confidence plus minus 5 margin, standard deviation 0.05. That will give you the respondent about 385 people, right? So 385, how to get this kind of response? Okay, maybe you get about 30 or 40 in practice. It's still okay lah. In practice, it's still okay, 30, 40 lah. For me lah, for me, other lecturer may be more difficult. I don't know. But if you're going to use 90% confidence level, of course, you will not be 395, will be about 100, I think 140. So practically, if you get 30 or 40 people as a respondent, will be okay. That is, if you are writing an article on a short article, then it should be suffice lah. Don't need to write the whole. You're not gonna write the whole 40,000 words. Leave it for your thesis later on, right? Okay. Who is not familiar with writing a thesis? Everybody is familiar. You are not familiar, lah.
Yeah, I'm not familiar, Prof.
Who is that? Julaila, lah.
Yes.
You are not familiar. In your bachelor degree, do you write any thesis?
No, I'm a degree in law.
Oh, you have a degree in law. So in the law,
Yeah.
maybe your bachelor of law, LLB. In LLB, you don't have any thesis to write one.
Not thesis.
Oh, this
You
will
just
be a
say
little bit difficult. But anyway, you have one class that's
That's
called
why
you have one class that's called
Prerequisite, is
research
it?
methodology. Okay. You have one.
I'm not attending that class because someone said that I have to submit the article or submit the assignment to him.
Yeah. See, actually, the article is maybe a summary of a thesis. Okay, it's a summary of a thesis. But you got 10 chapters, 10 subjects. You may have to write 10 articles, but it's the same sort of structure. It's only lesser words only and lesser complexity. That's all only. That's how to write an article. If you don't know how to write a thesis, I suggest you go to YouTube or go to ChatGPT. I cannot teach you. I cannot teach you.
Yeah,
I myself, so I myself already actually forgot about the thesis. This was long time ago. So, but
So take out your
maybe
old
we
thesis
can,
book and see lah.
set the two.
Take out your old thesis book and see. Okay, so anyway, Dr. Salma will be teaching you research methodology. Okay, and also Oyapan will have one class, the final class. There are two classes actually relevant for you. One class is a research methodology where I teach you all the statistics tools, right? And the other one is the thesis as a subject. Thesis as a subject, they will teach you they will tell you something about chapter 1 to chapter 6. Okay, so you better attend the class. Okay.
Okay.
Yeah, better attend the class. Okay, yeah. So,
but so the
okay.
thesis, we just the title, right? This is different from the articles, right? The article we have to write for each of the subject, right? So thesis is one
yes,
of the.
my understanding is for every subject you need to write article, but for thesis you write only one thesis for the whole MBA. Okay.
Oh, I see. So we have to start from now lah. Can.
Well, it depends on you.
Because the research
you start, the better lah.
methodology, I saw the schedule. It will start on I think
your final
maybe
exam
next
also
year, right?
January or
Not this
February.
year.
I think your final exam also
final-
either January or February. So you need to finish the article.
2026 or 2027?
No. No.
Next
26.
year.
26. Okay. There are many of
I
you.
see.
Okay. Anybody else got any question like to ask me?
Sir, Fabian here.
Yeah. Yeah, Fabian.
Yeah, so this means the title
is it we need to propose the title?
Yes,
or
yes,
the
yes, yes,
title
yes,
given?
yes. Yes, you need to propose your title. Okay. If you are actually doing an article on any one of the 10 subjects that you learn, should be no issue. Okay. But the important thing is, like, for example, of course, you're not going to write on something that you are not familiar with or you are not interested in, right?
Right.
So that's one thing. And the second thing, when you're either choosing what to write in the thesis or article, is can you get the data? Let's say, for example, you're in Malaysia right now. So let's say, for example, you want to do leadership in banking industry in Malaysia. So the title looks okay, right? The problem is, can you get the data to check what type of leadership is practiced by bankers in Malaysia? Now, if you cannot get this data, even though you make a questionnaire and then send out, and nobody answer you because the bankers are so busy or they don't want to bother about you, then it's not a very good title. Because let's look at the practical side. The practical side is when you want to write something, you must be able to get the data, then you can write on. If there's no data to write on, you cannot do. Right? So let's say, for example, if you are now in Malaysia, you say, okay, the effect of, let's say, Shopee, okay, effect of advertisement on consumer behavior or buying habits in Shopee. That maybe you can get the data because you will send out, it's a general thing, so many general people can give you the information for your quantitative analysis. But if you're too narrow, let's say leadership in banking, how many bankers you know? Maybe we're talking about top level of management, talking about practicing leadership in their banking company. You may not get this information. So how are you going to write your article or thesis? You understand what I'm saying?
Yeah,
Yes, sir.
Prof, can I
Yeah.
say something? Can I do my thesis related to the law?
Yes. No problem. So, like, for example, there's a subject called business ethics. So we can write business ethics in Malaysia, or code of governance in Malaysia, the effect of code of governance in Malaysia, or if it's law, isn't it?
Yeah.
What
Can
that one?
I say that it's
Activities, remedial actions for breach of contract. Okay, as long as it's part of business administration, then it's okay.
if I narrow down like managing financings in banking open to corruptions, for example, can I
Can
do
you get the
that?
data? Can you get the data? So if you're using secondary
Yeah,
data,
sure I
if you
get
can
it.
get secondary data, then it's okay, no problem. Maybe you're talking about Anti-Corruption Act or something like that, right?
Yeah.
Code of Corporate Governance, right? CSR, Corporate Social Responsibility, that sort of things. Then you can just put into your thesis and article, no issue.
All right. Okay.
Anybody else got any other question before we proceed?
I have a question, sir.
Yeah.
No, sir, no.
For the journal that will submit end of this February, should be
Yeah.
published?
Yes. Hang on. There are two types of articles is published. Published question is published where? Are you going to publish in Scopus Index Journal? Now, Scopus is a body, and under that body got many journals. So you can make your own journal, and then you put yourself into Scopus. They will review it, and if they think you are good enough, they will put your journal as Scopus Index. So you have index 1, 2, 3, 4 levels depending on the scrutiny, okay, of the level of scrutiny of the articles. That need to pay. Okay, I'm not talking cheap. I'm talking maybe about 1,000 or 2,000 US. Now, who pay? I don't want to answer that question. Okay. Now, another type of articles is like, for example, don't pay. Okay, don't pay one, free one. You have got such articles, but if it's overseas articles, it still have to go to peer-to-peer review. That means your article will be open to other people to comment, and if they think your article is no good, they are not going to publish it. And now the other type of article is you can publish, for example, Lincoln journals. Okay, so Lincoln Journal, I think I'm not sure, but I think you will be free. I cannot confirm that. You have to ask your coordinator. In this case, is Dr. Selman. Now, normally, if you want to write a Scopus index, you want to publish it in the Scopus index, it will take maybe even 6 months to 1 year, okay, to finish their peer-to-peer review. So it will take a long time. So I think you should hope to be allowed to be published in the journal, published in Lincoln self-journals instead of overseas US or American journals. Okay, at least you don't have to pay. Right? Okay, any other question before we proceed? Okay, everybody please make sure you submit your continuous assessment, because assignment 1, assignment 2 case study, and also presentation here makes up 50 marks. Okay, makes up 50 marks. So please make sure you submit. Okay, I think you all know where to submit, so it's here. I think recently somebody said they cannot enter in, but already do the editor already. So editor now it should be open for everybody to submit. Okay, I think earlier we have this problem here. Now anyone with the link, last time was just viewing, but now it's changed to editor. That means anyone with the link can edit, sign in, require anything you can do. Okay, to do the editing. Only thing is that once you enter here, you cannot delete. Right, so if you enter the wrong one or you need to have a new update, just resend again. That's all. Just resend again. Don't worry if you submit in the previous wrong one. Just resubmit again. Okay. So now today we like to go through something. So we would like to go through, for example, topic 6. Okay. It deals with capital structure. That means capital means the share capital structure. Okay. Now there are many types of share capital. For example, you may have ordinary share capital. You may have preference shares. Okay, and you may also have some company have a class A share, class B shares. You know, class A can do voting, class B cannot do voting. That sort. There are many types of capital structure. Now the new Company Act. If you last time we have the memorandum and association. In the Company Act, that's been replaced already by the new Company Act. So please go through and see. I think now bonus share, I think no more already. They stopped issuing this type of shares. So just go inside. But anyway, we're talking about types of capital now and the cost of capital. Now we start with sources of finance. Here, I'm not going to go through very detailed. So anyway, sources of finance is internal. That means company make profit. So that profit, if it's translated to cash, that can be is a source of finance. Okay, your retained earnings or your previous profit that is kept in the company. Those money that's not given out as dividends, the balance of money, right? So there is a source of finance. Another internal sort of finance is that you can sell your inventory. Okay, it's a source of finance. Or you may invoice to some people, right? And credit term is 60 days, but you cannot wait. So you take all your invoices, go to the bank and do discounting. Okay, so but they will not give you 100%, and they will select which of your customer only they will do discounting. And even if that invoice is $100, the bank will not give you $100. Okay, so that's another type of internal source. Now, external source, well, you can issue share capital. If you're a private company, it's a little bit difficult because the number of shareholders, I think, is maximum 20. So not many people like to invest shares in a private company because they cannot go and sell it easily. Of course, you want to yourself, if you want your shares to be easily sold and bought, of course, it will be public listed. Then you are going to follow the SE. Okay, all the rules, then to get your shares to be listed in the Bursa. Okay, that's one source of finance. Now, for share capital, you pay dividend, right? So it's a cost to you. Now, in Malaysian law, you can only pay dividend when it is out of return profit or return earnings or profit. That means you must have profit. You can only pay up to that amount of profit. You cannot pay dividend from your capital. Okay, so that when you go to external finance, you can borrow from the bank, right? And then here comes all the guarantees, and they will ask you a lot of things. Give me your past year balance sheet, your income statement. You have to write a report and so forth to convince them. The key is that when you go to the bank, you have to remember they need time to process. And at the end of the day, they say, okay, it's good, but they also take time. But what happened at the end of the day, they say, cannot, I'm sorry, please find another bank. That will give you a problem. Therefore, when you're talking about cash forecast, okay, when you're doing your budgeting, if you're not doing budgeting, doesn't matter if you're doing a cash forecast. So you need to forecast in the immediate future, right? 1 year, 3 years, or 5 years. If it's by 1 year, monthly, please. Which month is your lack of money? And let's say if you are lack of money, let's say in May, you better go and see the bank in January or February, so that the loan documentation can be processed smoothly, and then they give you the money that's needed. As far as the bank is concerned, you will have things like the OD, right, or outright term loan, right? So depending on the conditions and the guarantee they will ask, maybe directed to sign, or maybe they ask you for some security, okay, deposit in the FD for, let's say you borrow 10 million, they want you, okay, at least take 1 million and put in the FD for them, that sort of things. So you have to look at it. Now, the only thing about sources of finance is if you ask external sources, you have to pay interest. Whether you make profit or you make loss, you have to pay interest. So it's expense to you. Okay, so if you compare with dividend, well, dividend is going to be declared. Of course, the directors can recommend a dividend in the AGM, right? And if the shareholders don't agree, they will come up with their own resolution at the AGM, or during the voting in the AGM, the resolution to pay, let's say, a 10% or $10 per share dividend, it can be it will lose the vote, and then you may have to have another AGM again to put in the new proposal. So in practical, many companies, public listed company, actually they will look at their competitors or the industry. What is the normal dividend trend? The dividend can be in terms of amount, okay, or a percentage, okay. It can be a few methods of calculating the dividend amount. And then in practice, some of the company actually talk to some of their majority or significant shareholders. They already sound out to them already. We're going to give 10% dividend. Do you think it's okay? If it's okay, then you don't mind, we want to put into a resolution to be voted in the AGM. Okay, so they already got some feedback already, so most likely. Okay, now the other topic is called the weighted cost capital. Now the weighted cost of capital, notice the word is called weighted, because when you look at your financing, you may have debt, right? Maybe a short-term loan or long-term loan, maybe you got the OD, okay? And maybe you will have the share capital. Right? So you got many types of financing for your business. So what's the weighted? So you just calculate the expected return times by their share, and then you can do the average weighted to find the weighted cost of capital. Now, why do you want to do that? Let's say, for example, your calculator, your weighted cost of capital, let's say for your company right now is 10%. And if you want to do investment, so that in any project or any shares you want to buy, or you want to buy your factory, you want to see what's the cash flow coming in, right? The return based on that project in net present value must be positive, and the IRR, okay, internal rate of return, that percentage to be higher than the weighted cost of capital. All right? You know what for you do this project? That's how we use this weighted cost of capital. That percentage there is used to calculate the net present value, okay, to see whether it's positive or not positive. You may have any one time few projects, right? And you don't know, and your money is limited. So which project, A, B, or C? So you look at the net book value, sorry, you look at the net present value and you put in that percentage in the calculation, okay, to go and calculate which project A, B, or C, which has enough return for you based on your risk, right? That's how we use the weighted cost of capital. Now, I think, let's look at it. Weighted cost of capital. So this is an example here. Okay, so you can just follow the example, then you can see the cost of capital. Okay. When you're looking at projects, okay, there's a formula, there is a video for you to see how to calculate the weighted cost of capital. So there are few formulas you can follow. Example, all shown here. And because your financing structure will inclusive of debt, and debt will have to pay interest. So interest will be treated as an expense. So let's say, for example, your interest is 10%, you borrow from the bank charge you 10%. And let's say Malaysia, let's say the corporate tax rate, for example, 20%, right? So you have to pay for every $100, you must pay $20 as an interest. So that interest is treated as expense in your company. Okay, so therefore, when you're calculating the weighted WACC, when you're calculating WACC, right, you have to consider the tax implication because you are saving $20 on 20%. So you're saved 4 already, okay, for the net impact. Okay, so anyway, you can see the formula from there. Now, okay, a capital structure theory, what it means is that how many percent must be debt and how many percent must be shares. Now, there are a few theories. The first one is M&M. Okay. Now, M&M theory, they got theory 1 and theory 2. What is with tax, one is without tax. The theory number 1 is the old one, without tax, not applicable. Okay. Theory number 2, M&M theory number 2 with tax is more applicable. Now, what M&M say is that a firm main purpose is to generate profit. How will you generate profit? Make some product, do some services. That's how you make. So it's not important how you do the capital. That is according to M&M. Okay, so this theory is quite famous at that time, but maybe this theory is not so good theory. Okay, not a good theory. So another good theory is this one. First one is M&M theory. Trade-off theory. The trade-off theory is inclusive of the tax. Okay. Then you have another theory, which is called the pecking order theory. There's no optimal debt equity ratio. Okay. So follow asymmetric information means that if you have more information, asymmetry means some people got more information, some people got less information. So the capital structure, again, it's important for that. Okay. What it means is that very simple. First, use internal fund. That's the pecking order. First order, use internal fund to finance your business. Obviously, because you don't pay any interest. You only pay dividend when you have a profit. And the amount of dividend is subjected to negotiation between the shareholders and also between directors. Then issue the safest security debt. So first is use your profit. Second, go and borrow money. Third, issue new shares. Now, why is issue new share the last option? There's a danger when you issue new shares. If new shareholders comes in and they buy over some of the shares of the existing company, they take over your company. That's one of the risks of issuing new shares. Second danger of issuing new shares is you have to get the people coming. You have to convince them. So if you're going to do an IPO, you must make all the documents, you must have a very good business plan. Then only you can issue shares. Of course, if you borrow money from the bank also going to look at all this kind of thing, but not so detailed. Documentation for the bank loan is lesser detailed than documents for the IPO to go to the security exchange, okay, to be listed in the Bursa. Okay. So the modern application is a combination, trade-off and pecking order. Okay, so it's up to you. sometimes in practical, it's not what you want sometimes. Because financial, we have a financial formula and say, okay, this is not the best way, you know. But in practical, sometimes debt is good, but you cannot get people to lend to you, right? In practical, maybe a profit is good, but you don't have a good profit in the past. So you have not accumulated enough cash. So it depends on situation. So I think capital structure, it depends on the economic situation, the opportunity you can get, the threats that you will face, and so forth. Okay. So that is called the capital structure. So how do you know which is the best structure? There's no such thing. Time by time, it change. Industry by industry, it change, right? Now, if your company is doing a lot of project work, maybe let's say make a highway, make a condo, okay, you need a lot of money, and you will not get back anything until the condo has been completed in 3 years' time. So you may have to borrow a lot of money as a long term. So you're matching your type of borrowing to the needs of the project or the needs of the investment. Okay, so if you can get the money, but it's fine. But if you cannot borrow, you have to use your own profit or you have to issue new shares. So it depends on the situation. There are a lot of things, complication, your firm name in the market, okay, overall market conditions. Do people have enough money, you know, to invest in you and so forth? Okay. So we have the theory here, the 3 theory. So the core idea and then how is it being done, and then and so forth. Okay. Now leverage, there are 2 types. One is operational and one is financial leverage. So when we talk about leverage, we have this formula. The higher the leverage, investor will be more nervous, the percentage. Okay. The higher the leverage. Because if you look at the formula carefully, change in net income and the change in sales, right? So if your income now is, let's say your sales change 10%, income increase 20%, therefore your leverage is become 2. Okay. High leverage means most likely it is a risky, because high return, high risk. Okay, high return, high risk. Okay. Or the other way should be better to say high risk means you expect high returns. Okay, low risk, low return. So depending on the project and depending on the type of company it is, who is calling the shots. If the person is an old man, he's scared of risk, right? So he will look for low leverage. If you're a young person, you always got income coming in, so you happy with risk. Therefore, you will look for high leverage. Now, why is this leverage part of the capital structure? Now, if you're an entrepreneur firm, you just come out, you're new, you're not an old company like Nestle or no, Milo, that kind of company, you're a new company, most likely your real leverage will be very high. The percentage will be, your ratio will be high. Okay, your ratio will be high. So for that kind of company, since you know the leverage will be high, you're going to invest. If you're going to looking for investor to come in, angel investor or whatever, you should be looking at investors that also have the same risk profile as you. So if you're an entrepreneur, you're a young fella, and you're not too worried about risk because you expect a lot of revenue coming in, right? So your leverage high, so you're looking for those people. Investors have the same risk profile as you. But if you're an old company, mature, old company, stable, your leverage very low, right? So when you want to issue new shares, right, you want to declare that you're not going to pay so much dividends. You want to be very, I won't say pessimistic, but I say you're very careful with your information to investors or to lenders. Okay, that's how you look at it. Okay. Okay, capital structure, there's a summary here, leverage, financial and operating. Okay. Okay, we look at one case. Okay, I think most of you know who is Amazon. Okay, balancing of debt and equity in the age of AI investment, right? AI investment is very huge because they use a lot of not only AI chips, electricity, right? And then a lot of GPUs to do the multi-language, which composed of machine learning and machine inferencing. So how they going to, they need a lot of money, okay? So how they going to do it in terms of financing, debt or equity? So for this case study, so they also use the WACC, WACC, okay? They also have a problem to decide what is the optimal capital structure, the blend of debt and equity that minimize the WACC. Because the lower the WACC means the lower the return that you actually need, okay, to be successful. So that means lesser risk, okay. So look at it, and this is the reference, okay. You can get more about this information from this reference. Go to internet. Then your activities is formulate, appraise. Now here you don't need to give me.
Look, then what is that?
Huh? Here you don't need to give me any but this is only for your own thinking, okay? For case study, only your own thinking. I'm sorry. There's a lot of background voice. If you are not speaking, can you off your background, because I hear some children voices. Can you do that, please? I don't know who is it, but can you just off your mic? Here, just off your mic. Okay. Anyway, you see the same material, so you can just look at it. So, any particular question on the capital structure?
No, sir.
Okay, so now let's go to the next one, dividend. Of course, if you are issuing shares, you need to pay dividends. So that type of dividends. So basically, it can be steady. Every year we pay $10 per share. Okay, very steady one. Or another type, not so steady. Another type is that 10% of the profit. Profit high, some year profit low. Okay, so the amount is fluctuating. Okay, so one is a stable amount, quite nearly fixed amount, $10 every year per share. The other one is maybe 10% on the profit. Now, the another method is balanced method. What it means is that the directors will reserve some money for investment, the balance to be distributed out as dividend. Which is the best way? How to say? Company by company. If you're an investor and you are scared of risk, you go for the first type, right? Constant dividend. You know what you will get. But if you like risk, because risk got good return, you go for the second type of company. Second type of company is very simple. Profit more, get more. Profit less, get less. The third type one is not that popular. That is where the balancing method. Whatever is the balance of the money, we declare as dividend. Okay, so that's one. Now, how's the payout? One payout way is cash. Okay, one payout way is cash. Now, the other way of payout is a little bit different. Share buyback. Now, instead of the company, let's say the company got 10 million cash. They can pay out as dividend cash 10 million, or they take the 10 million, they don't pay as dividend. They go to the market, stock market, they buy back the shares. That is called repurchase. Now, what's the impact when you buy back shares? Number of shares become lesser. The company, money is still there. The money is no more there. They pay out to buy new shares. So the number of shares become lesser. So if next year the earnings are the same, next year earnings per share will be higher because it's earnings per share. Now the share become lesser. Same earnings, share lesser. That means the earnings per share become higher. Now, normally in the share market, share price is to a certain extent determined by the earnings per share. So if you do stock purchase, you will not get dividend cash. You will get reduction in the number of shares. Therefore, your share price will be higher. And next time when you sell the share, you get the profit from the sales of the share. That means you don't get dividend now, you get dividend in the future when you sell your shares. Now, why is that like that? Why do company want to buy? Now, we are now looking at tax law. In Malaysia, we have a single tier tax. What does that mean? The company pay tax on their profit. Okay, so net profit before tax, let's say it's 100. After tax 20, so net profit after tax is 80. So that 80, they can pay as dividend. And if they pay the 80 to the dividend to the shareholder receive the dividend, they don't have to pay tax on that dividend. Because the argument is the company they pay tax front end. And the balance is distributed to me as a shareholder. I don't need to pay tax again. That is called the single tier tax. Okay. Of course, the shareholder need to declare in their income tax return the dividend amount, but there is tax rate is 0. So the amount times 0% means no tax. Now there's another type of country. For example, USA. Now in USA, they have a double tier. What does it mean double tier? The company pay tax on their profit they pay to the dividend as shareholders. The individual shareholders, they declare, and in their country, in USA, they pay tax one more time on the dividend. That's why you pay double. So it looks a bit unfair. So why should I, the shareholders, company already pay tax already on the profit, and I get the balance of that amount as dividend, and I pay tax one more? Looks like very unfair, but that's the law. So that is called double tax. Now, because of this type of law, now if you're a company, you already pay tax already. If you pay dividend to an American fella, the American have to pay more tax, maybe not so happy. So instead of that, I take the dividend money, I went to the stock exchange and I reduce the number of shares. I buy back the shares. And once I buy back the share, I delete away the shares that I bought back. So therefore the number of shares become lesser. And next year, if the profit is still the same, so earnings per share is higher, share price become bigger, higher share price, and I sell next year, I will make the profit. That profit is not go to income tax. That profit maybe go to real property gain tax or capital gain tax, depending on country. And then normally it's lower than the normal multi-tier tax in country. Okay, so that's why in certain countries, they may not want to pay cash dividend. They may want to do repurchase of shares. So is that understood? Now, that's one thing. Now, another thing, practical one. If your shareholders is overseas, in Malaysia, we just pay the money out. Now, there are certain countries, there are certain payment that you must do withholding tax. Now, in Malaysia, there's no withholding tax for dividend because it's single tier. Let's look at the now American company. In America, they have to pay dividend. And their shareholders are in Malaysia. Shareholders in Malaysia, company is in US. US, they pay dividend, the money come to us here. Now, the US government want to take a share. Because the US government cannot tax me in Malaysia. I'm in Malaysia, I don't file any income tax return in US. Right? So the US government may want to have a want the US company to do a withholding tax. Now, depending on country, different type of withholding tax may be different rate. In Malaysia, normally we have 10%. Okay, maybe US is a different rate depending on years and so forth. So the company, when the US company, when they pay the dividend to a Malaysian shareholders in Malaysia, they deduct some money to the government and the balance sent back to Malaysia. Okay, so that is In Malaysia company, no issue lah, because no, we are single tier. Okay, yes, we are single tier. So next one, is dividend relevant or not relevant? It's actually relevant, because if a company pay dividend, it means the company got cash. Understand? It means the company thinks in the future they also got money to pay. If not, they will not pay dividend. They will take the money and reserve it to do investment. Okay, or the company now is short of cash. Company not doing well, short of cash. Therefore, they cannot pay dividend. So the fact that you pay dividend, it means that your company is should be okay. And we know you can only pay dividend out of profit. You're not paying dividend out of capital. You cannot sell your fixed asset and take the money and pay dividend. That is against the law in Malaysia. Okay, under Company Act. Okay, so in Malaysia, if you are paying dividend, if the company is paying dividend, we have a sort of assumption that you have enough cash, or else you cannot pay, right? And we have certain assumption that most likely you are profitable. That's why you can pay. Okay, so that is a good signal. When you pay dividend, that's a signal that you're doing okay lah. So normally you see companies, they don't pay dividend. Most likely they are not doing well, or there are those companies that don't pay dividend because they want to use the money for future investment, right? For future investment, then maybe they'll get more profit and maybe the earnings per share become better. Therefore, the market price become better. Therefore, you make the profit later on. Okay. And we call that homemade dividend. The word is called homemade dividend. What is homemade dividend? We don't receive dividend. The money is put in the company to keep on reinvesting to generate more profit. Earnings per share will go up in the future. Share price go up. I make the money later when I sell the shares. I don't receive the dividend cash now. So that is called homemade dividend. So it depending on the company. Some company like Amazon, so many years never pay. Okay, the dividend, because they have got a business. Their way of doing business is to invest, then finally only get the benefits. Okay, so I think it's quite important. And well, if you're a company that is stable, you will attract investors that expect a steady dividend. If you are an entrepreneur company, maybe you will attract investors that is risk prone, because they know maybe you make big profit, you get more dividend. So, but anyway, there's one more thing. Why should pay dividend? And that is called the agency problem. Now, if the company got cash, and if you don't declare dividend, that big amount, the directors got funny ideas already. So they will take the money as a director, for example, they will go for investment tour, take all the directors with all their family, go for investment tour, so-called investment tour. Actually, it's holiday, but they use the word investment tour, use the word company's money to go for investment tour to investigate investment in another country. So that is one of the problem of agency theory. So to combat them, so the shareholders prefer not to have so much money so that the directors don't get funny ideas. So please pay dividend. Okay. So these are third one. What are the factors influencing a dividend decision? Law. First one. You can only pay dividend if you got profit. Next, liquidity. Do you have the money to pay? These are the common factors. Okay. Then the third one, factor influencing business decision. We don't pay dividend because we are not single tier country. We are a double tier taxation system. That means we don't pay dividend. You guys do homemade dividend. Okay. No pay dividend, buy back the shares. Share price go up, you sell later. So these are the factors. Which is better? Share repurchase, homemade dividend, or just normal cash dividend? Depending on countries. Okay, depending on the type of investor you are. So if you are one type of investor, you will buy one type of company that pay dividend, right? If you're another type of investor that take risk one, you buy another type of company. Or if you're in a country that have double taxation, maybe you don't want to prefer to have dividend. Okay. So far, clear? Any question? Say something. Guys, say something.
Clear, sir.
Clear? Because you know why sometimes the line cut off and I keep on talking. I don't know whether you're still in the room or not. Okay.
This
Okay.
is I think more straightforward, sir. So easy to I think
Okay.
gain lah so far.
Okay. Okay. So now we'll go to here. Okay. Your subject is called business accounting and finance. How come suddenly management accounting is there? It's because it's part of the book of knowledge as decided by the Ministry of Finance. Ministry of Education. And I think you're familiar with financial accounting, that where they come out the trial balance, the balance sheet, and the P&L, and so forth. Now, management accounting is making information for managers to make decision. Okay? The management accountant do not make the final decision. In many cases, management accounting will take information, make information to give it to higher management, and from this kind of information, they will make decisions. Okay, so based on that, we start with the first one, cost concept. Now we got a few type of costs, right? First one is fixed cost. Fixed cost is like, for example, your company, you're doing a rental, let's say you're renting an equipment, and whether you use the equipment 24 hours or you use the equipment 1 hour in a 1 month, it doesn't matter. You already sign a contract, that is a fixed cost. You can be a good one like renter, insurance you buy per year, for example, road tax. So these are the type of expenses that we call it fixed cost. Okay. Now the second type of expenses is called variable cost. Let's say, for example, you want to make this one and sell this one. So for every one of them must have one red bulb. You make 1 million of them, you must have 1 million red bulb. So the cost of this red bulb is the variable cost. So you have variable cost for every one of this item. So the more you make, more the variable cost. But the per unit is the same. So if this is 10 cents, you make 1 million, you pay 100K. If this is $1, maybe the cover here is $1. So you make 1 million, is 1 million unit, you make 1 million, you have to pay $1 million. So that we call it variable cost. But the unit cost is the same. It's $1 for 1 unit. Now fixed cost is different. Now to make this one, maybe you rent a factory or you rent a machine. Whether you run or don't run, how much the output is based on contract. You already have a rental contract, right? So that is a fixed cost. Now, why do we differentiate fixed cost and variable cost? The key is, normally, we will look at how to reduce fixed cost. Variable cost is easy to repair, control. Because, like, for example, this 10 cents, I just change supplier. Right? Fixed cost, you sign the contract for 2 years or 3 years rental. How are we going to change? You already fixed. Therefore, because it's fixed by nature, you try not to overspend on fixed costs. Variable costs you can still do, because this month you buy 10 cents. Next month I can buy 9 cents with a different supplier. Okay, that's how we classify cost. Now, why is this important? To know the fixed cost and to know your variable cost. Now, in theory, you have this thing called okay, so for example, this is the units of production. Let's say you're making mineral water units, and this is the ringgit amount. So whatever units you produce, you're renting the machine is a fixed cost. This is the variable cost. You're making mineral water. It may be labor, the plastic bottle itself. So the more you build, the higher the cost. So this line, if you move it to here, this is the total cost line. Okay, total cost line. Now, why do we classify it? Because based on theory, we have this theory called marginal analysis or break-even point. I think some of you may have studied before. It says that a very simple theory. So this is your fixed cost. This is the variable cost. Variable cost now move in sequence. Start with here. Then this is the total cost line. This is your sales. And therefore, when they match, this is the break-even. So break-even quantity is 250. That means you must tell the marketing people, hey, every month, you people marketing better sell 250. When you sell 250, total cost equal to sales. Therefore, no break-even, no loss, no profit. If you sell below 250, we're going to make loss. If you sell above 250, we make profit. Logical. Theory. What's the problem with this theory? You don't make one product in your factory. Maybe make 10 or 20 products. Very seldom got one factory only making one product. Maybe Tenaga lah, electricity, right? Other than that, no company make one product. It's too dangerous. So even though you may have mineral water, you also got small size, big size in there. Whether you oxygenated or maybe just well water, osmosis water or something, mineral water from here and there. So there are many products, many size. You have to make this kind of chart. Problem is your fixed cost. How do you allocate the fixed cost? Because that machine is making various type of products. When you rent a factory, the factory make various type of products. So the fixed cost need to be allocated to various products. Therefore, it becomes arbitrary when you allocate the fixed cost. The variable cost, no issue. Variable cost, every type of product have their own variable cost, depending on the quantity and the amount to be spent. The unit each is the same variable cost. But the fixed cost is the problem. So you do need to do allocation. And whenever you allocate your fixed cost, let's say your fixed cost is 1 million, how do you allocate? You may have 5 products. You allocate based on sales amount, you allocate based on number of employees or difficulty or arbitrary percentage, whatever method you use, it is still judgmental. And because it's judgmental, it's not accurate. Therefore, this chart is no good. And that's the problem. And you will ask the marketing people to go and sell 250 and they cannot sell. You see, the problem is you are trying to sell your sales amount. So see, can you see the sales line? More unit, more revenue. Because you're selling each. Each is 10 cents, each or 20 cents or whatever it is. So you're selling and you got this cost and you tell the marketing people you must sell at least 250. What's the problem? When you're doing business like this, you've got a big problem. For example, this is a mineral water business. The customer don't care about your fixed cost, your total cost, your variable cost. The customer only see the sales price, whether it's okay or not okay to buy. So, traditionally, people always do like that. What is my cost? 10 cents. What I profit? 5 cents. I sell 15 cents. And then let's go and make and sell 15 cents because that's our cost, 10 cents. I want profit 5 cents. I will sell 15 cents. The market, the customer don't care. The customer only see 15 cents, yes or no. Correct? So this is a big problem if you are doing this way. Because customer don't care about your data. So then, okay, if that's the case, sir, how do we sell? What price should we do? Here comes a little bit practical. Okay, let's look at okay, let's make it a little bit bigger so you can see easily. Okay, let's say, for example, your sales is composed of your cost. Can you all see? Say something.
Yes, clear.
Okay, let's say you want to make this, you'll make this Excel, okay? Okay, so you cost you 100, okay? And let's say you want profit 20 because you need to pay your salary, you want to do investment, therefore your sales is 120. That's the normal one. Right? You know your cost, you want the profit, so you make your sales. Problem is, the customer don't care about this. The customer only interested in this figure. Whether I'm going to pay 120 or not for this one. What should be the correct method? what is the sales price. How do you know the sales price? You go and do a market research. What is your competitor doing? Now, for example, your market research will say your sales price can be like that, or your sales price can be like that. So what's the profit you want? So let's say the profit, you still want 20 bucks. And therefore, this is called the target cost, which is fixed and variable cost. Understand? So here is 90. Here is 110. Okay? So this is very good for you. No issue. Because now you can sell higher than 120, right? You maintain, so your cost can be. That's not really a problem. But the problem is this. If the market, customer don't care, based on market research and your competitor, they only want to pay, they only want to pay 90. So now the customer only want to pay 90. Now you got many customers. Let's say you're making mineral water, you got 1 million customer. What is the average price? You have to go and find market research based on, get all the data, maybe do a normal distribution, at least 1 sigma, 68% of the answer is within that range. That will be the price. Maybe that's the average price for 68% of the people. Okay, that you go and ask them for pricing information, or you market research and see what price your competitors charging. So let's say 90. It's like you go supermarket right now. You go and buy mineral water. Do you care about this? You never care about this, right? Am I wrong? You never care, right? You only care whether that product, if you think you will buy at 90, it will be 90. So therefore, if you still want to maintain, the target cost will be 70. So now your actual cost right now is 100. Oh, we got a problem. Because the actual cost right now, I have to spend 100, but we can only sell as 90, and the profit must be 20, so we can only have 70. That is why you need to analyze your fixed cost and variable cost and do activities. You have to do activity to move from 100 to 70. Financial accounting only records 100. Management accounting is to get the information, how to make decision for the management to reduce it to this 70. Do you understand that? So far, any problem understanding?
Yes, I get it.
Sorry?
Yeah.
You understand? It's like you go supermarket, you buy. You don't care about this company thing. You just only want to care whether in this price you want to buy, you can buy in it. So if that's the case, you've got a problem. So now you have to improve from 100 to 70. Now, every time you don't improve, now you can improve to maybe it's still 70. Now you slowly maybe go to 90, maybe go to 80 after a few more months, and maybe go to 70. After very, very much improvement, go to 60. That's what you must do. That's the job of you in accounting, right? Under management accounting, beside the financial accounting, your job is to now highlight what is the cost right now. And the management will decide how to go from 100 to 90. Okay. Sack all the high-paying people, employ the cheap people. How to go from 90 to 80? Bring more machine. How to go from 80 to 70? Oh, maybe get some technical assistance from somebody. How to go to 60? We merger with horizontal merger, go up the supply chain, because when we make this one, got plastic, isn't it? Right? So we buy over the plastic company. Whatever you need to do, you need to do because you're only selling 90. And to do that, you need to know your cost. And if your cost is like that, you need to split into variable and fixed costs. Correct? So the variable cost, you must go and find new suppliers, cheaper price. And fixed cost, you must try to, oh, hang on, can we renegotiate or can we move to a new place, cheaper rental or whatever it is? But that's why I say, number one thing is you try to reduce, don't overspend fixed costs. Because once you sign the contract, it's difficult to change until the contract expires in 2 years' time. Make sure don't spend so much on fixed costs and variable costs, go and find other suppliers. Think of other ways of doing. Okay? Very clear? Clear?
Clear.
Clear, sir. Clear.
Thank you.
Okay. So this one, you know what's the result of this one? No, look at this result. So you still try to sell 120, right? And the customer only want to buy 90. So what do? You get a marketing manager lah. Hey, marketing manager, go and sell 120. The marketing manager cannot sell because your customer research was not done well. So you do not know the customer want to buy 90. You only look from your side of view and you want to sell 120. And the marketing manager cannot sell because the customer only want to buy 90. And then what do? You sack the marketing manager. You sack the whole marketing team. And you're bringing a new marketing manager. Does that sound? You heard of this thing before? Marketing
No.
manager cannot meet target. Right? Marketing manager cannot meet their target. So we sack the marketing manager. We sack the whole marketing team. We bring in another whole team. You come back to the same problem. You're still looking at sell the 120 where the customer is only want to buy a 90. It's because you didn't do this way. How do you get this 90? You get this 90 because you do market research. What is the price that the customer want to buy? The average customer want to buy. What is the quality they expect? How do it to be delivered? How do you promote it to those people that this possibility want to buy? In marketing, you got 4 products or 4P. Price, product, promotion. What's the other one? Right. Place. Place is logistic supply chain, how to deliver to the customer. That's why you have a lot of cases whereby marketing manager keep on changing. Because people are still thinking like that. They are not thinking like that. Now, if you are thinking like that, this is the job of everybody in the company. How to reduce costs. Every day. Because if you can reduce cost to 60, let's say for example, now you reduce your cost to 60, right? What do you get? You get 30, friend, profit. You understand? Each time you are delayed, now your target cost is 90. Each time you are better. Your improvements will be equivalent to your profit. That's the key for accounting people. I'm not asking you to go and make the product. You're not production. I'm not asking you to do the R&D. You're not the designer. I'm not asking you to become a marketing, but I'm asking you to the management accounting people, the accounting people to get this information out so that management can make a decision how to drop this cost. You need to highlight that currently your cost is too much crazy. So you need to highlight how to reduce this one, how to step by step. Japanese are very good. Okay. They
Without
always
compromising the quality, right, sir?
Okay, having said that, this amount is a customer want to pay. It depending on which market segment you're doing. Let's say, for example, you're making, okay, you're F&B. You are doing low cost F&B, medium cost F&B, or high class fine dining. If you select one market segment, that market segment, what is the size they want to pay? For each market segment, for the price they want to pay, has got the same equivalent level of quality. Okay, now to ask you, to make you understand this one, that's why I asked about quality. You all know BMW? Everybody know BMW cars? Okay. Everybody know Proton car?
Yeah, yes.
Yeah.
Which has a better quality? Come on, BMW and Proton, which has a better
Oh,
quality?
of course, the BMW, sir. Even though
Wrong
we
answer.
wrong answer.
Yes, this is a trick question. BMW quality is for BMW pricing.
Oh, yeah. True.
Proton quality is Proton pricing. So if your customer is Proton, you better be Proton quality at sell at Proton pricing.
Okay.
So that's called
Listen.
R. You know,
Okay.
right quality, right pricing, right
Okay.
quantity.
Oh.
You, when you're working in Proton, Proton quality like that one. I also got no heart to work in Proton. Better I change job in BMW. BMW better quality. It's a wrong thinking. If you are in Proton, you try to reduce your cost and you try to improve your quality without increasing your cost. Or maybe cost increase a little bit, never mind, you can increase the sales price. But you cannot look at quality, BMW and Proton. You're not comparing apple with apple. You understand?
Yeah. True, sir.
Okay? BMW.
Okay.
So if BMW make a very cheap car, would you want to buy? Oh, no, I don't want to buy. You know why? If you buy the BMW, very cheap BMW, we laugh at you. You got no money. You have to buy a poor BMW, man. Correct? Now, if Proton make a very, very expensive car, very, very expensive car, 300,000, 400,000, Proton, you want to buy? You stupid. Better you buy BMW, isn't it? That is the key. Understand?
Okay.
Now, continue with this one. You can make this product at this price. You better make sure got people buy, no? Many people say, I know how to make chapati, so I make a restaurant chapati. Each chapati costs 100, the profit is 20, so I will sell each chapati 120 because I know how to make chapati. When you do market research, not only are you looking at pricing, you're looking at whether is there enough customer in that market segment. You've got very few people. Look, you cannot sell chapati in US. Nobody eat chapati. So even though you're very good chapati, even though you got very good cost, it doesn't make sense. So this kind of pricing in market research can only be done well if there's a product for it. There's a market for it. That's why you do market research. Okay? So not only must you have a market for it, you must know what they want to buy. That is the most important. And second thing, you must know what is the profit. So if you're now 90, you expect zero profit. Therefore, you need to improve your cost. And how to improve your cost? Look at your fixed cost, look at variable cost, think of how to improve. Don't think about raising the price. You know, when you raise price, the whole world shouting. Not only the customer shouting, the competitor also shouting at you. Competitors suddenly reduce their price to take over your market. So what can you control? The sales price, you basically cannot control. It's controlled by who? Sales price is controlled by customer. Because the customer is the one who take out the wallet and pay you. Cost, you can control. Why? You sign the contract for fixed cost. You select which supplier to buy from. You select which quality, which supplier, at what price. Therefore, cost you can control. So cost you can do. So do. This one you cannot do. Just get the information. That's all. Understand? Simple, huh? So don't follow this theory. Okay? Don't follow this theory. But I had to teach you because inside the syllabus. Anything else? Budgeting, I think most of you know is budgeting, so I'm not going to talk about this. But when normally when we do budgeting, okay, so let's say for example, this is not price, this is quantity. Okay, so this one may be the average. Okay, AVG. So maybe this is average, maybe this is the best scenario, and this is the worst scenario. Okay, So now you can have a thing called a flexible budget or whatever it is. So sales, best average is 90, best maybe 110, worst maybe 70 lah for our business. Okay, for this kind of product or whatever it is. And then we will say the probability. Okay, maybe this is 50%. Okay. Maybe best one or we are very, very gung-ho. So maybe not 25 maybe 10 only right? So this one must be. We are very pessimistic. Okay. So you just times lah. Times this. Times this. Oh, let me do the formula. So then the total. Now, why cannot one? Typo error. Oh, got one more behind. Yeah, okay, accept. Okay, so your forecast, you can either be based on 90 or based on 84. Okay, based on 90. But normally we were based on 90. And then the accounting will make one more set of budget figure for their own keeping, just in case, for flexible budget. Okay, now this percentage and this amount is all based on forecasting. So when you're doing forecasting on these sales, the percentage of achieving, right? Please be honest, don't have any bias. Okay, please try your best. You can, this is one method of doing, putting in the best average and the worst sensitivity. Okay. That's how you normally, yeah.
It's not necessarily the lower the sales, the higher the profit, right? Because when I look at this comparison, how to project.
Okay. Can you remember just now the example? Okay, this example.
Okay. Yeah.
Okay. Everything depending on your cost, not the actual cost, the target cost. If you can achieve, if you can achieve the cost, if the sales price go down, then you must be more working on the cost go down.
Okay.
That's all only. If the if the price don't go down, but you're very good in your improvement in cost, you get more profit. Okay. So this is only for the financial thinking.
Okay.
Other thinking is different.
Depends on the cost.
Yeah, now, most of you will understand what is SWOT, strength, weakness, opportunity, threat. This is wrong. You should always be OTSW. You should also look at the external opportunity, external threat, because you cannot control. Then only you look at your strength and weakness, and then you will use the opportunity. No, you will use your strength to take advantage of your opportunity. When you're doing strategies, what product to make, when to make. Okay, so this is not a good concept, because if focus on the internal, if you're focused internal, you are thinking like this. Understand? If you're focusing like that, you're thinking the other way now. Just now the other example, can you remember? So your mind must change. Can you remember just now the other example? Yeah. So that one is what? OTSW. What your company can sell or cannot sell. Right? At what price? So we take care of the opportunity and look at our strength. So if now the opportunity is the customer want to buy at 90, right? The customer want to buy at 90. This is the opportunity. That may be also equivalent to the threat. The threat is you guys want to sell 120, but outside opportunity is only 90. So now you must look at your strength.
90.
Okay? Now the opportunity is you can sell 90. Your strength, you have to reduce your cost. Use your strength to reduce the cost. Then maybe your cost will not be 100. Maybe your cost now become
90.
So this is sales, this is external. And if you use your strength, so if your cost now instead of 100, if your cost now is, let's say, 60, do you know your profit will be better? It's a very simple logic. Understand?
Yeah.
This is practical thinking.
Okay. Oh. Yeah.
Okay? One is normal thinking. Besides this, other normal thinking is I know how to make mineral water, I will forever make mineral water. You don't care whether the market wants or not. That is because of this thinking. When you do SWOT, you are having this type of thinking. But when you are doing OTSW, you have this kind of thinking. Understand? See, the sales is not here. Sales is first line. Here, the sales is last line. Different thinking. Okay.
Okay.
So budgeting, forecasting, and then planning and control, you can read nothing much now. Okay. 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 So we'll finish with done. Okay. Now I want to do chapter 10. Then after that, I go to chapter 9 because chapter 9 is complicating. Okay. Chapter 10 first. Okay, impact of technology and accounting and finance. I think most of you will have know what is a blockchain. So blockchain is a technology, and how do I say? Bitcoin is using this technology, blockchain. Okay, if you do not know what is blockchain, go to internet, or I can explain to you here. Okay, so it's all by blocks. Your data will be in block. And once it's verified, let's say, for example, you got a transaction, you do a sales invoice. So that is a transaction you can put into a block. And then you need to be verified maybe by, say, your accounting manager or your marketing manager. Once they are verified, that block stay forever there. Then it will be linked to another block. So now when your money comes in from the invoice, that is for this block 2 is linking. First block, raise the invoice. Second block, cash comes in. Right? So all these blocks is, how do I say, you cannot change. Okay? Because it's built into the IT. Okay, so you have lesser chance of people playing around with it. Therefore, when you have confidence in the numbers, because somebody put a block and somebody verify, and there's a chain of the subsequent events to see. Okay, so auditing is very simple, and because you're using IT, most of you will use some sort of software, so you get monthly report and so forth. Okay, so it's not an issue, and you get it very fast. Normally 1 day closing for accounting. Okay, so here is something about AI and finance. Okay, now the word here is in finance. Now, what is AI? Now we are in first generation of AI. Okay, first generation. ChatGPT, DeepSeek, Gamma. What call them? Google, Gemini. Gemini is Google. ChatGPT, DeepSeek, Gamma. Okay, this kind of example of AI is first generation of AI. How does it work? It works very simple. You have a lot of CPU to extract a lot of data. After that data, the CPU extract all the data, and then they store this data in the cloud. Use a lot of electricity. Okay, a lot of electricity. So the expensive thing is not only the chip, no, the GPU. Okay, it's also the electricity. Now, okay, so now they will put a program that is called machine language. Machine language learn 2 things: machine learning, machine inferencing. INFERENCING. Inference, if you know the English word. So the first part is learning. So how does the computer learn? You load in everything in the internet, your email, your WhatsApp, your email, your WhatsApp, your TikTok, your Instagram. Don't be crazy. You have no idea. They're all loading in. Everything in the internet, library, document, articles, books, everything, they load everything into the computer. That's why they must have very fast chip, because there's so much data, right? And then they must so much space to keep it. That is called learning. Okay, so the computer learn. And then now here comes the inferencing. Inferencing is something like judging. So let's say the programmer teach the computer. what is a bird? You know, then the programmer say, or based on all this photograph, what is a bird? Got feathers one lah, got 2 wings. Understand? It's a bird. So when you show him a paper of a parrot, he say, oh, that's a bird. He show you a picture of an eagle. Oh yeah, got feathers, got wings. That's a bird. So you show the picture, you ask ChatGPT, they say, oh yeah, eagle is a bird. Okay, a parrot is a bird. Suddenly you show him a picture of a penguin. You know penguin? They feel like got no feathers one, right? And also got no wings, only got flippers. So the IT the computer have never learned, because they only learn a bird got feathers and got wings. 2 wings and a lot of feathers. Here comes a picture of penguin. The IT the computer get confused. AI, oh, get confused. This is not a bird. But biologically speaking, we have classified a penguin as a bird. So now we have to go and teach the AI. Hey, this is still a bird lah. What you learn, feathers and wing is correct. Beside that, also got this kind of thing, also can be considered bird. Then the AI knows. Now the problem is, it's so complex that AI sometimes give you the wrong answer. So don't think AI will always give you the correct answer. AI will only give you the answer from what they learn and what they inference. Inference means the AI look at the picture of the penguin. Oh, it does not match their earlier understanding, which is feathers and wings. That's why the inferencing, the AI will inference a penguin is not a bird. And because when if you find out, you can take countermeasure. What happens if you don't find out? For forever, the AI will keep on saying penguin is not a bird. It's okay. But what happens if it's for medical or for accounting, right? Or stock buying or stock selling? So it becomes a big problem. Okay, so that's what you mean by multi-language. Okay, learning, inferencing, give you the answer. Now, how does it affect finance? We're going to pump in a lot of data. So based on a lot of data, based on historical past, if the company make this kind of profit, the share price will go up. Okay, or the competitor make a different type of profit, then our share price go down. These are all the data. It's all loaded inside the computer. Then you let the AI run automatic. Now, finance is 24 hours all over the world. Okay, Tokyo is working, US is sleeping. US is working to buy and sell shares, Tokyo is sleeping. That means somewhere in the world, 24 hours, somebody is buying and selling shares. Now, all these people are all using AI. And all of them got their own AIs to buy and sell shares. And the computer will automatically buy and sell shares if you let it. If you agree to let the computer, maybe you got some safeguard up to $1 million or up to one amount of shares. Anyway, you already put inside the computer. Why? Because you want to have it automated. Because the share market keep move very fast. So you want it to automate it, and then straight away, the computer will do a buy or do a sell of the shares. And because of that, it's moving so fast. So when you're sleeping, somebody outside there, another country is moving the pricing, then suddenly you wake up, oh, I make big loss, oh, I make a big gain. That's the impact of AI on finance. And it can be dangerous. Dangerous good or dangerously very bad. Right? So please be aware of that. So that nowadays we are doing a lot of automatic trading by AI, buying and selling of shares. Okay. And you give them the permission. Why you give them permission? Because you cannot monitor 24 hours and you cannot react so fast. Okay, so they use whatever computer learning and inferencing to do it. Now, next one. What's data analytics? Data analytics means look at data and to analyze. And we're looking at big data. What is big data? There's so many data in the world. Let's say, for example, you're making chocolate, and you want to know who is buying chocolate. Okay, so how do you know? Okay, I went and talked to Aeon. Aeon got all the records. You have the card. Each time you buy something, you slide the card. So you capture your data. When you buy, what you buy, how much you buy, and the price you pay. So we tell Aeon, hey, give me the data. And I use this data. Now, the word is called big data. Why? So many data. in the world. To extract this data, there are some good data analysis. You pay a lot, okay? You pay a lot for this data analysis to get the data relevant for you, so that, oh, I want all data of what type of chocolate they're buying, what price, where they are buying. With this data, my factory can make the correct chocolate at the correct price and sell where. Data, big data and data analytics is basically the first part of just now I say, research. Okay. Last one is cybersecurity in IT. Now, when you do your business, whether you're doing invoicing or you have employee records, your sales record, your employee record, your supplier record, all these are subjected in Malaysia to Private Protection Data Protection Act, PDA. Private, I cannot remember the word. There's one act for it. Private Detection Act, I don't know what it was act. So that act you have to follow. You cannot simply play around with data and cannot give the data without people permission. But people still get the data because they're hiking or somebody is selling the data. That's all only. Right. So you have to be careful with your data, or else you will get. Okay. We have the risk management and technology RMIT policy document. Yeah, PDA, Personal Data Protection Act. So now your company may have got a lot of personal data. Let's say you're a hospital, you got how many personal data, medical records, right? Let's say your Aeon, you have a lot of personal data because you're collecting data from your customer, what they buy, when they buy, and what they buy. These are all personal data. You're not supposed to sell. You're not supposed to use it. You can use it for your own self, okay? But you cannot actually sell it out. So sometimes when they ask you to get the card, they give you an Aeon card or whatever, Paradigm card or whatever it is, you better look at the fine print when they sign. Sometimes they will say we will use the data for something. Okay, so which reminds me, right? So if you notice, right, when I give you the assignment, okay, let's look at the assignment. Remember this assignment, right?
Yeah.
3 current issues is the right one, isn't it?
Mm.
Declaration. My original work has been written by me, has been subjected to plagiarism, not previously submitted. Last one. I give permission for my assignment to be reproduced, communicated, compared, and archived for plagiarism detection, benchmarking, or educational purposes. You never read this one, right? You know why I write? You know why I write like this? Personal Data Protection Act.
Okay.
Okay. So I can use your
Yeah.
assignment or say around no more. You got no more personal attention because I asked you to sign here. Correct, Okay.
Sorry. Yeah.
Okay, anyway. Okay. Okay, I think we
Okay.
have finished. This is the last chapter, and I only got 20 minutes. This is the most difficult chapter. The theory is on investment and finance decision making. You say, hey, sir, wait. Are you going to give any tips for your final exam? You die. There are 10 topics. Section A, 6 questions out of 10. Each question 10 marks. 6 questions. Section A, 6 out of 10, 60 marks. Part 2, case study, 4 questions. Sorry, your exam not now. Maybe February, I don't know. Okay, maybe that time, maybe we have one short course just to go through the exam. Okay, I'm not sure. Okay, I cannot guarantee you. But in the meantime, please learn by yourself. Okay, so now let's look at this. This is the most difficult topic. So let's go through. I don't have much time. I think you should spend time on this particular chapter, especially if you're interested in finance or how to do investment, or if you're in the position in the company to evaluate one investment with another investment. The first one is called the portfolio theory and diversification. Portfolio means a mixture of assets. What do you mean by assets? Okay, like for example, you got a certain amount of money. Let's say you got $100. Okay, I spend $20 to buy Magnum shares. I spend $20, I buy Sun Derby shares. I spend another $20, maybe I buy Maybank shares. That is called a portfolio. I'm splitting up my money into various type of shares, because if banking industry die, my Maybank shares will go down, but my Sun Derby share not affected. That is called diversification of risk. Okay, now it's not just share. I got $100. Okay, maybe $100. I want to $50. I buy share. $50 I put into FD. Okay, or maybe I got $100. I want to buy government bonds. $10. Maybe I want to invest in entrepreneur company shares. $10. Maybe I put in my house as cash. So it's all a mixture of assets. The reason is to reduce the risk. If any one of them problem, the others not problem, you don't lose all. Now, assuming you put all your money in one company bankrupt, then what are you going to do? Or you put all your money to buy a building, suddenly nobody stay in that hotel, what are you going to do? So therefore, we are saying that to diverse, you may have various type of assets. Okay, so split out your money. Or if you have no money, then forget about portfolio. Okay, but if you have money, right, you don't have the big money, small money, or whatever the concept is, you need to put your money in various category of assets, depending on up to you. Maybe you are young. I put $80 of $100 in the entrepreneur company. 20 FD. Yeah.
Is it a portfolio referring to all the cash asset only? Or
No.
how's it?
Yeah. Hang on.
Mm.
The portfolio theory is not only for shares. Any type of asset. Okay?
Any type.
Any type of asset. So your assets can be building, land, machine,
Fixed
share
asset all
investment,
lah.
bonds. Any type of asset. FD, fixed deposit, any type of asset. You must, a portfolio theory is very simple. Diversify your risk by investing. In other words, don't put all your eggs in one basket. Some egg in this basket, some egg in another basket, some egg in another basket. That is portfolio theory. That's all.
Oh,
Okay?
Okay.
It's not just only shares. You always get. So now let's look at the, when we talk about risk, because we want to reduce risk, there are two types of risk. One you cannot control. Uncontrollable. This type of risk you cannot diversify. You cannot reduce, because this type of risk is open to the market. For example, COVID. When COVID strike, all business die. That's all. So you cannot diversify your risk, because it is systematic risk, macro in nature. Okay, price risk, investment risk, political risk, and something like that. Okay. Now there's another type of risk that you can control, because this type of risk, systematic risk, is basically opportunity and threat. This type of risk is your strength and weakness. You can control business risk. Okay. Okay, let's look at it. Interest rate risk, you cannot control. Why? Interest rate is controlled by the banks, controlled by the government. You only one company, right? Market risk. Okay. Booming market, recession market, you cannot control, because you are not the only investor, or everybody is investor. Inflationary risk, general inflation, you cannot control. Okay. Now, there are some you can control. Your business risk. Certain, if you're in that business, you can control that risk. Okay, let's say, for example, you're in the, how you say that? Let's say you're making mineral water. What's the most important? Water, isn't it? So can you control that risk? Yes. You buy some storage tank, right? Or financial risk exposure, currency exposure. For currency exposure, what must you do? You can buy forward exchange, right? Operational risk, okay. Maybe machine. So maybe you can have risk for that machine, but then you have a maintenance contract. Your machine down, you can call it, come in. So these are all unsystematic. Sometimes they would use the word A. asystematic. Sometimes they use the word unsystematic. This risk you can control, you can diversify. This risk you cannot control, you cannot diversify because it's beyond your control. Okay? So we are talking about risk that we can control and we can diversify. Okay? Now, this is a very famous one. Okay? We call it the efficient frontier. Now, you as an individual or as a company, you can have portfolio A, portfolio B, portfolio C. You can have many portfolio. Let's say $100. Okay, this one is $100, 50-50 shares and a fixed deposit. Here, $100 maybe is 50 as short-term lending to people, or 50% buy share in A. Maybe here is buy share in B. Inside this portfolio, got a few type of assets. So you can have many types. When you start to calculate the risk and the return, the extreme line here is called the efficient frontier. That means you should follow that portfolio that is near to the outside. Portfolio that's inside here, no meaning. Better use the outside one. Now, if you are scared of risk, you use this portfolio. Low risk, low return. If you're okay with risk, you use this one. Okay, high risk, high return. And then you keep on changing sometimes because of conditions or whatever it is, right? The key point is you need to make various type of portfolio. You maybe people get a confusing idea. One person, one portfolio. One company, one portfolio. No, you can have one company and you just stick on one portfolio. Can, but that's not efficient. What you should do is you should think of other portfolios, other mixture, other types of portfolio, because every one of them got different risks. Okay, so there's no limit. So when you make portfolio, it's an art. It's not a science. The art is which type of asset you want to put in here. Each one of them is $100. Okay, so therefore it's an art, cannot be taught. Okay, and after you have put in the art, the brilliant portfolio, you draw the wonderful chart, and this you could draw this line. It actually don't have to draw this line. Actually, you can see easily one. Okay, so you can at any one time, if you think now is a dangerous. Okay, Indonesia going to attack Malaysia. Oh, so we better take this portfolio. Low risk, low return. Oh, okay, nobody. Everything going to be rosy. Okay, so you better take this portfolio. Also can. Okay, because high risk, high return. So for understand? So the misconception is portfolio is only for shares. No, portfolio can be for any class of asset, any types of asset. Second misconception is one portfolio. Yes, that's many people believe. Actually, is there are many portfolio. It's up to you to make the portfolio and then draw this line. And at this line, which one you want to do? Okay, so far understand?
Yes.
Hello?
Yeah, understand, sir.
So this is an art, no? Everyone
Yeah.
there's $100 one, everyone there's $100, you understand?
Yeah.
So this is efficient frontier. I think last time you have studied financial management before, isn't it? Maybe your lecturer teach you the same way. I'm not sure. Okay. Some of you may have studied financial management in the first year. Okay, CAP. Now, how to pronounce this is called CAP-M. Now, weighted average capital is called WACC. Modena one is called M&A. So there are certain words where if you say CAPM, those people who know one will say, hey, you're not so correct. Maybe they laugh at you, right? So sometimes in finance, especially in finance, there's a lot of funny things. So like the beta sign, the alpha sign, the sigma sign, you must know the sign, the pattern, and you know how to say, right? It's like you are in the loop, huh? You are in the loop. Okay. So this CAPM. CAPM is a formula. Oh my God. Okay. So this is a formula. It's a fundamental tool. I want to highlight this. Everybody use CAPM. Okay. to determine the rate of return for the asset, typically a share. But you can also use the concept of CAPM for other assets. Okay, but anyway, I'd like to show you an example of CAPM for a stock as an investor because it's a finance subject. Okay, so it's built on the idea that the only risk you can compensate or diversify is based on the it should be based on unsystematic risk. Particular plan. You're not worried about this, can be diversified away. So CAPM is only based on market risk. Okay. Therefore, there's a wonderful formula here. Later I'll explain to you why. So you follow all these words. Okay. You follow all these words. And these are the words. I don't know. You read this one. Okay. And then you will have the formula will have a beta. So the beta is covariance and variance. So you need also to study statistics. Okay. So why? Because what is the weighted average cost of capital? Now, your financing, like I said just now, can be composed of debt and share capital. The portion may be different, and the dividend rate is different, and the interest is different, right? So you need to calculate your weighted average cost. Why you want to calculate weighted average cost? Because that percentage there, the average weighted cost is the percentage that you will use to measure against the various project returns or various stock portfolio returns. And if the return is more than your WACC, go ahead. If the return of the project is lower than the WACC, don't get involved. Okay? So WACC capital formula is percentage of equity times cost of equity. Here is where the CAPM comes from. This is CAPM plus 1% of cost minus 1 over tax rate because the debt but had to pay interest, so had to minus the tax rate. So I think Malaysia most likely will be. What's the company rate here? 20% or 21%. Okay, just one follow. So you can calculate. So you calculate the WACC. So you get a WACC. So look at rate. Never mind. So CAPM model, same thing. Now, how do you get this risk-free? Risk-free rate. This is CAPM formula. You go to ChatGPT and ask what is the risk-free rate for Malaysia for today. Okay, most likely they will quote you a bond rate. This beta, you need to calculate beta. I think down will teach you to calculate data. What is the return of the market? So how to get the risk-free rate in Malaysia? Ask ChatGPT. Ask ChatGPT what is the market return. In our case will be KLSE index. Okay, KLSE, the average return. So you will follow this formula to go and calculate the CAPM and put the CAPM into the weighted cost of capital. Okay, just now this one. Okay, and you can use this interest rate to calculate your net present value. I think earlier chapter I teach you the time value of money. And the time value of money, you can put in the interest rate. What interest rate? You can put the WACC interest rate, or if it's a borrowing money, it's the actual bank interest rate. Okay. So you can calculate these. These are all the formulas. Okay, this one not so important. Working capital, cash, everything. This one not so important. Not so important right now. Oh yeah, hang on. Like today,
Sir,
yeah.
the CAPM can also be used in public sector investment, right?
Yeah.
Okay.
Hang on. Maybe I can help you. You just ask because of formula. Okay, here's a CAPM formula. Risk-free rate, expected return of the market. That means in this case will be KLSE, and the beta. Okay, so the beta is the risk option. Okay, never mind. Yeah. I just went to ChatGPT and asked for the country RF and RM. So this is Malaysia. So they actually, I think this one was, I didn't put the exact date. I think it's about 2-3 days ago only. So you had the risk-free rate for country, so you can use this rate. And you have the expected market return. Okay, so it's Malaysia is about around 10%. So you can put in these two formula. The only thing is the beta. The beta you have to calculate based on the formula. This is a formula covariance. You have to study statistics to study this covariance and variance. It's actually quite simple one. I just show you an example. Okay, so for example, Apple stock, last 6 days trading, or last 6 years trading. Okay, what is the Apple returns? Okay, earnings per share, something like that. It doesn't matter the return, and there's a market return. What's the growth? What is the return of the? This is a US because Apple. So we're using S&P, Standard & Poor. Okay, market index. So this is return. So then you calculate the average. Okay, so 1.25 here, and this is the market return here is 0.55. So the covariance, you have a formula market return. So the Apple, each one of them minus the average. This is the Apple minus mean. So the market return, again, the market average, this average is all this return here. You can get the return now, just go to ChatGPT, ask for it, one doesn't matter one. Okay, then you can get the then. So this times this is the product, add up all this product, this is the covariance. Okay, because the formula is covariance divided by variance, right? So now you have to study what is the market variance. There's another way of doing market square or market variance. Therefore, you will do this. I suggest you learn for this one, if you want to know CAPM, to learn more calculate. And CAPM is very popular to be used because it quantify the risk. Okay, see the way it quantify the risk. Okay, so this Apple gain, the return, what's the average return? And then the market, what's the market average return? This times this, that is called the covariance. Then covariance divided by, so now we already analyzed the average Apple versus Standard & Poor 500 average. Okay, so we know the volatility of the stock. Then we have the variance 0.59. So the beta will be just divide 2.09. What does that mean? That means this share is very, very volatile. If it's 1, no issue. If it's above 1, volatile. Below 1, not volatile. Very, very steady. Okay? So if it's 2.09, what does that mean? That means if the market move
Above 1?
No, if the market move 10 points, Apple will move 20 points, plus and minus. Okay? Market down 10 points, Apple down 20 points. That is the beta. And once you understand this beta, okay, the volatility of the beta, and when you do the CAPM, where is the CAPM? Once you use the CAPM, because CAPM, you must calculate, you must use the risk-free, and then use the market. ChatGPT give you the figure already. Calculate your beta. Once you calculate the beta, you can calculate using covariance and variance. Covariance divided by variance. Once you get a CAPM already, you can calculate the WACC. Once you calculate the WACC, all investment. So if you're going to invest in Apple, this is your cost percentage. The return better than this or worse off than this percentage. That's all. So because here already consider the risk, what risk? That risk that is inside the beta. Volatility, what how to pronounce it? Volatility, right? Already take the average, the market average, and you the Apple average, right? To calculate already the beta already, you already consider the risk already. Beta is actually the risk portion, right? So you already consider this, so you can calculate right now. Percentage of equity times by the beta of this stock times the debt plus the cost of the debt. This is the outside one, the borrowing one. Okay, the loans. 1 minus that, get the WACC. Use this one to calculate your NPV, net present value, and to calculate your internal rate of return. Okay, and when NPV is positive, means you are okay, because we consider time value of money, because the time value of money is using this rate. And the IRR, the answer, can you remember the I teach you about the time value of money, isn't it? Right. So when you use the one, then the IRR percentage should be higher than this WSCC. Then you're okay. So far, okay. You understand what I'm saying?
Yeah, so far okay.
It's very complicated one, but CAPM is the most fundamental tool. So if you can
Yeah.
understand CAPM, you can understand the risk. Okay,
So
you are
far,
finance
okay.
people. When you are doing finance, you have to consider risk. Higher the risk, higher the return. You don't go and invest something high risk, low return one, not so smart. Okay. Okay, so now, as far as the final exam is concerned, I think most likely before your final exam, there may be one short session, maybe. Okay, one short session, maybe. I think so. Okay, it depends on the coordinator. Okay, you may have a short session, maybe we can go through the final exam. But if most likely if it's not on site, not in Lincoln, you're at home, most likely it's an open book, right? And then you guys will know what to do lah. Huh? You want to say anything more? Okay. Wait, wait. Okay, hang on. Okay, I want to stop recording now.